Good afternoon, everyone. Welcome to the daily recap on what is still a lovely Friday here in New York City. I'm Evan Lazarus. I'm the CEO of T3 Live. This morning, for those of you that were tuned into the morning call, I talked a little bit about the market. We did some trend analysis, and we looked at both the daily and weekly of some of the broader indexes. And I talked about, how these types of patterns typically play out over time. And I want to reference it again. I want to jump back in here to the spiders. Today, not really a surprise, I should say, as the market broke out a couple days ago. And you can see the S&Ps here. Here's the spiders. You can see here, starting to see some real upside here. And like I said earlier, just to reiterate my point about trend analysis, typically these patterns end, or these types of long-term, upward trendly patterns. They generally, they'll last as long as they last, and I know that that's a very non-committal thing to say. Usually, I like to commit to what I'm going to say, but look, the basic premise of a bull market is bull markets take time to develop. You never really hear about bull markets that happen in a year or in 2 years. Even in the late 90s, or the tail end of that bull market, which was just an utter explosion to the upside, developed, for many years prior to that. And in this market, the same thing is true. This is not a new trend. This is not something that is, something new to anybody that's been in the markets, whether you're a day trader, an active trader, or a longer-term investor. This trend, this weekly rising 8, rising 21 above a 200 EMA, has been going on for the better part of the last couple of years. Really ramping up since the beginning of 2013, but ultimately starting, way back here, back in 09. And while it's had its fair share of ebbs and flows for the better part of 012, 13, and even into 14, we've consistently been in this rising 8, rising 21 type of environment. Now, bull markets are effectively a function of greed, and greed develops over time, whereas bear markets are a function of fear, and fear creates panic, and panic happens faster. There are two very different emotions, and they play out in terms of the language of price in very different ways. So bull markets typically take a longer time to develop, and that's basically what you're seeing here. But when you're at the tail end of a bull market, and I'm not certainly implying that we're at a tail end of a bull market here, but what I am implying is that when this starts to break away, this upside, you start to see real upside momentum, and these candlesticks, pull themselves like a rubber band off of, the 21 EMA. That's when you know that you have to, really, really be careful about some sort of snapback. And you've seen that, I think I can highlight that point effectively in stocks like, here's Tesla as an example. And Tesla, if we look at the weekly, Tesla is something that, again, up here, as it got really, really extended, here's the sort of that tail end of that up move. You can see, as I zoom in a little bit, I think it puts it into perspective, you can see the separation of price from that 21 EMA, and then you can see, that effectively marks some sort of end of that upside move, and then, the snapback, happens pretty drastically. And that is the basic premise of even the internet bubble. Just to kind of go into this point here, in the late 90s, if I can even scroll back to the late 90s, God, I can't believe I have to scroll back to the 90s. That's a statement. So you get to the late 90s here, and you can see that that separation where through the latter part of the 90s, we rode these averages. And these are the Qs, by the way. So I'm looking at the NASDAQ. You can see that separation. But when that separation effectively ends, and there's really no one way to figure out when it is when it is, you get that pretty harsh snapback. So, what am I saying here? Well, I'm saying that I anticipate that this may go, the markets may start to ramp up here. Again, I'm kind of putting it out there. I do think that that's a definite possibility. I think that, the longer we ride these averages and we start to, get these slower ebbs and flows, the longer this lasts. And if I'm wrong, then you're going to see another multi-week consolidation sometime in the next, couple of weeks, and then the same pattern will continue and continue and continue. What would be healthy, maybe that's not the appropriate word, but what would create a lot of volatility is some sort of large, like I said, that rubber band, you pull it up, 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 up. At some point when you let it go, it's going to snap back. So you got to be flexible here, meaning in the short term, I would stay with the trend. There's no reason to, fight it. Focus on trades that are working to the long side. This morning I talked about some of the trades in Off the Charts, our nightly trade ideas newsletter. LNG, let me go to the daily chart because I think it's a more fluid time frame. Here's LNG. Again, a recommendation is a breakout trade. Through 60, and in a quick 2-day period, you've seen this a pretty large percentage move here from 60 to basically 68 in a matter of 2 trading days. ConAgra, CAG, and I think again the one of the better points here to make is not necessarily highlighting good trade ideas. It's that there's a lot of diversity here. You're looking at stocks that have different types of composures, different markets, different industries, just different characteristics, different prices. We're not, you're not seeing a lot of these higher beta, higher momentum names where traditionally in the past, for those that are more active, you see the Apples and the Netflixes and the Googles and, the stocks that are more momentum driven. You're not really seeing that, in not as much here. Not to say there's not opportunity in those trades. You look at Netflix as an example. Now, Netflix was not a trade idea here, but these wild moves from 460 down to 300 back to 420, all in a matter of let's call it 8 to 10 weeks. So there's a lot of opportunity here for those active, nimble traders if you stay flexible. Although I will say not easy, but having diversity in this market is good. Having flexibility in this market is good. Having a functional watch list is good. And understanding overall general market conditions. And the reason that I've belabored my point here about the S&Ps and this weekly chart is that, if my analysis is worth anything, then, you could, like I said, start to see over the next couple of weeks some of that upside really kick in. So I'm not telling you to do anything. I'm not suggesting, that's going to happen. I'm saying that based on my experiences and having seen charts like this before, that's typically how these things end. And when you get that fast money, that easy money, everything's breaking out and going straight up, and it's almost like it's falling off the trees. While it's great to participate in that, and we love that because you're seeing stocks break out of ranges and follow through, and there's commitment, and it's directional, and what we call easy money, you do have to be wary of the fact that easy money doesn't last forever, and understand what it is you're doing and why you're doing it, what to expect next. A great trader, like a chess player, thinks, 2 or 3 moves ahead. So, while we live in the moment, we make money today, and what happens today or tomorrow, or you have to be, prepared and know what it is you're doing. That's ultimately what creates and defines success and longevity. As always, have a great weekend. Again, if you're not, if you're not tapping into some of the information we're providing here, whether it's intraday on the VTF or overnight in our newsletter products, do yourself a favor, get yourself, help yourself, because it will pay itself off in spades. I genuinely do believe that. And I hope everybody has a fantastic weekend. I'll talk to you next week.